If you are tired of hearing everyone say, just invest in index funds without actually understanding what that means, or whether ETFs might be a better choice for your specific situation, I get it. The investment world throws around terms like index funds and ETFs as if they're completely different animals. But here's the truth most people don't tell you. These two investment vehicles are actually more similar than different, and the choice between them might come down to factors you haven't even considered yet. Let me break this down in a way that actually makes sense for your money and your goals. If you stick with me until the end of this video, you are going to learn exactly how both of these investments work behind the scenes, the hidden costs that most beginners completely miss, and how to confidently choose the exact right option for your personal bank account. My goal is that by the time this video is over, you will have a clear and actionable plan to start investing today without any second guessing. First, let's talk about what these things actually are. Think of it like this. You want to invest in the stock market, but buying individual stocks feels overwhelming and risky. So instead, you pool your money with thousands of other investors to buy a huge basket of stocks. That's essentially what both index funds and ETFs do. They're both ways to own a slice of many different companies, without having to pick and choose individual stocks yourself. The magic happens because both typically track an index. An index is basically a list of companies that represents a portion of the market. The S&P 500, for example, tracks 500 of the largest U.S. companies. When you invest in either an index fund or ETF that follows the S&P 500, you're getting exposure to all those companies in one simple purchase. Now here's where things get interesting. The biggest difference between these two isn't what they invest in, but how and when you can buy and sell them. With index funds, you're locked into end-of-day pricing. Let's say you decide at 11 a.m. that you want to invest $1,000. You place your order, but you won't know the exact price you'll pay until after the market closes at 4 p.m. That's when the fund calculates something called the net asset value, which becomes your purchase price. Your trade gets processed after hours, and depending on your brokerage, it might take a day or two to actually go through. ETFs work completely differently. They trade on the stock exchange just like individual stocks. That means you can buy and sell them anytime the market is open, and you'll know exactly what price you're paying the moment you hit that buy button. You want to invest at 11 a.m.? Done. You see the market dropping and want to sell at 2 p.m., you can do that too. This flexibility might sound like a huge advantage for ETFs, but here's something most people don't consider. If you're a long-term investor who's planning to hold your investments for years or decades, does it really matter whether you bought at 11 a.m. or 4 p.m. on any given day? Probably not. The small price differences throughout the day become meaningless when you're looking at returns over 10 or 20 years. But if you're someone who likes to have control over timing, or if you're making regular small investments and want to see them go through immediately, ETFs might feel more natural to you. Let's talk about costs, because this is where both index funds and ETFs shine compared to other investment options. Both typically charge very low fees, usually between 0.03% and 0.20% per year. So on a $10,000 investment, you might pay anywhere from $3 to $20 annually in fees. That's incredibly cheap compared to actively managed mutual funds, which often charge 0.5% to 1.5% or more. Here's something that might surprise you, though. Many brokerages now offer commission-free trading on both index funds and ETFs. But there's a catch with index funds. Some brokerages require minimum investments, often $1,000 or more to get started. ETFs, on the other hand, let you buy as little as one share, which might cost $50 or $500 depending on the fund. This makes ETFs more accessible if you're just starting out or want to invest small amounts regularly. You can buy fractional shares of many ETFs through certain brokerages, meaning you can invest any dollar amount, even if it's just $25. Now let's address something that confuses a lot of people. You might worry about tracking error or think that one option is somehow safer than the other. The reality is that both index funds and ETFs that track the same index will perform almost identically over time. They own the same stocks in the same proportions, so their returns should be nearly identical. The small differences you might see are usually due to slight variations in fees or how dividends are handled, but we're talking about tiny amounts that won't meaningfully impact your long-term wealth building. Another consideration is taxes. Both index funds and ETFs are generally tax efficient because they don't do a lot of buying and selling within the fund. But ETFs have a slight structural advantage that can make them even more tax efficient in taxable accounts. This gets pretty technical, but the bottom line is that ETFs might generate fewer taxable events, which could save you money on taxes. If you're investing through a 401k or IRA, though, this tax difference doesn't matter because those accounts are already tax sheltered. Let me address something that trips up many new investors. You might think you need to choose between growth and value or domestic and international when picking between index funds and ETFs, but that's not how it works. Both index funds and ETFs come in all flavors. You can find both that track large U.S. companies, small international companies, bonds, real estate, or any other asset class you can imagine. The question isn't what you want to invest in, it's how you want to buy and sell those investments. Here's my take on who should choose what. If you're someone who likes to set up automatic investments, maybe $500 every month from your paycheck, and you don't want to think about timing or market movements, index funds might be perfect for you. Many brokerages make it easy to set up automatic purchases of index funds, and you'll never be tempted to try timing the market because you can't trade them throughout the day. If you prefer more control and flexibility, or if you're starting with a smaller amount and want to add money irregularly, ETFs might be a better fit. You can buy them instantly, you can invest any amount, and you have the option to get more tactical with your timing if you choose to. But here's what really matters. Whether you choose index funds or ETFs is far less important than actually starting to invest and staying consistent. Both are excellent tools for building long-term wealth. Both offer broad diversification, low costs, and solid historical returns. The biggest mistake you can make is spending months researching the perfect option instead of just picking one and getting started. Time in the market beats timing the market, and it also beats endless analysis of minor differences between similar investment vehicles. Your investment success will depend much more on how much you invest, how consistently you invest, and how long you stay invested than whether you chose an index fund or ETF. So here's my challenge for you. Instead of getting stuck in analysis paralysis, pick the option that feels more natural based on how you like to manage money, and then focus your energy on the bigger questions. How much can you afford to invest each month? What's your target asset allocation between stocks and bonds? Are you maximizing your tax-advantaged accounts first? Those decisions will have a much bigger impact on your financial future than the index fund versus ETF debate. What's the one factor that would make you lean toward index funds or ETFs for your specific situation, and why do you think that particular feature matters most for your investment style? Let me know your answer in the comments. I am going to be reading through them, and honestly, your perspective might be the exact thing that helps another viewer finally make a decision and get started. If you got value out of this breakdown, hit that subscribe button so we can keep building wealth together without all the confusing Wall Street nonsense. I will see you in the next one.